The prediction market for a Federal Reserve rate cut at the next FOMC meeting has just undergone a sharp and decisive repricing. The yes probability now stands at 42%, down 14 percentage points from 56 in a single trading day. With nearly $2 million of volume flowing through this contract in 24 hours, this is not a casual or speculative move. Something has materially shifted in how informed market participants are reading the Federal Reserve's next step. Three headlines converged to drive this repricing, and each deserves careful attention. The first and most significant, the latest consumer price index came in at 3.4%, a full 0.3 above the 3.1 that economists had forecast. In the current environment, that kind of upside surprise materially complicates the Fed's path toward easing. The second, remarks attributed to Chairman Powell at a preparatory session ahead of Jackson Hole carried a distinctly hawkish tone. Rather than signaling accommodation, Powell appeared to counsel patience, and markets read that as a clear rebuff to near-term cut expectations. Third, and perhaps most telling for internal Fed dynamics, two voting members of the Federal Open Market Committee publicly pushed back on near-term easing. When individual voters break cover in this way, it signals that internal consensus has fractured. Together, these three developments constitute a material and coordinated hawkish repricing. What does a 14-point probability drop actually mean in practical terms? Before this move, the market was pricing what analysts would call a coin flip plus scenario. A cut was the statistically expected outcome. Now, at 42%, that picture has inverted. No cut has become the modal view, the single outcome that the aggregate of market participants now considers most likely. It is worth pausing on the size of this contract. $3.15 million in active liquidity means this is not a thin market subject to large participant distortion. Sophisticated capital is positioned on both sides, and both sides have been repricing. A 14-point swing on this volume, in a contract this deep, is among the most credible signals prediction markets can produce. When probability moves like this in a liquid market, the information content is real. Beyond the raw probability movement, the smart money flow signal for this market reads, sell. Understanding what that means is important. In prediction market analysis, smart money flow does not simply track volume, it tracks the directional activity of participants who have demonstrated a consistent track record of accuracy across many prior markets. These are not casual participants reacting to headlines. When this signal aligns with the directional price move, as it does here, it provides a powerful layer of confirmation. The interpretation is clear. Informed, high-conviction participants have been reducing their exposure to the yes outcome, that is, to a rate cut occurring. Crucially, there is no divergence between the smart money signal and the price action. No divergence means no basis to interpret the move as overstated. The signal and the price are in full agreement. This kind of sharp repricing is not without historical precedent. In the months preceding the 2023 hiking cycle's pause, strikingly similar episodes unfolded. Inflation data surprised to the upside, Fed speakers adopted coordinated hawkish language, and prediction market probabilities for near-term cuts collapsed sharply and then remained suppressed for weeks before any meaningful reversal. Today's correlation data tells a comparable story. Related contracts covering Fed pause duration and terminal rate expectations are showing directional moves consistent with a broad repricing of the rate path, not an isolated market anomaly. Historically, when inflation prints and Fed communication align on the hawkish side within a compressed window, these repricing episodes tend to be durable. On the available evidence, this does not look like noise. The catalysts to watch are clear. A downside surprise on the next consumer price index release would immediately reopen the case for a cut and could push this probability back above 50% in a single session. Conversely, further hawkish remarks from Fed speakers, or additional FOMC voter dissent over the coming days, would cement the current repricing and potentially press the yes probability toward 30% or below. The FOMC meeting itself is the hard deadline after which this contract resolves and the forecast collapses to certainty in either direction. Subscribe to this channel for weekly in-depth prediction market analysis, and follow us on Polymarket Trade to track this and every major market move in real time.